Langdon was founded about 3 years ago, 2022, and we're solely focused on global small caps. The reason being we, as the previous speaker, see so many opportunities given the number of companies and the fundamental and structural under-resourcing within small caps, which we're going to touch on. What we own at Langdon is a collection of businesses that generate great free cash flow, great free cash flow margins, low leverage, etc. No manager will stand in front of you and tell you we're looking for poor quality management teams, levered balance sheets, and bad companies. But essentially, what that leads to is owning a collection of more obvious quality companies. And so what we think and what we focus on is owning non-obvious compounders. That could mean a lot of different things. It could be a company that in the short term doesn't necessarily screen well, so having low returns on capital or not ideal free cash flow generation, or a company that does screen well, but perhaps trades at a really high multiple without any context. And so ultimately, we think the investment industry attracts very smart people, very curious people, and also very optimistic people. And that oftentimes leads to a lot of prediction. And so in the world of small cap, and because of our business owner mindset, we want to be in the world of observation as opposed to prediction. And we think that today, more than in the past, it's very key to have a differentiated view on every single investment idea that your managers have when they're investing. Why does this matter today? This is the 16-year compounded annual return of the S&P. Now, I don't think anybody would have guessed that when we put these numbers together. I was certainly surprised. And so what that simply means is today you're paying significantly higher multiples for a lot less growth, especially when considering real growth. And so today, more than in the past, it really, really matters to have a differentiated view when looking into companies. And we think that within the world of global small caps, there's a lot of alpha to be taken by your managers. And today we're going to talk about 3 examples. As Adam said, we take a lot of first meetings globally. The team's organized by region. The reason being we think it's more efficient in terms of travel and building relationships globally. We meet about 500 companies per year. That's about the S&P 500 every single year. And some things that aren't captured on here would be us going to trade shows, talking to ex-employees, and things of that nature. But then the question becomes, are you just taking these meetings because you're curious, and what value are you actually getting from these meetings? And so we think we have built a repeatable process, which boils down to 3 different things. Number 1, we think that we do differentiated work. And that differentiated work allows us to gain the management team's trust to get differentiated access. And once we get that differentiated access globally is when we can truly find a differentiated view on a company and be closer to the world of observation as opposed to prediction in very nicely built Excel models. The first company I'm going to talk about is a company called Royal Unibrew. It's a Danish business that's a multi-beverage company. In simple terms, you can think about them as almost portfolio managers of beverage businesses. They're in the world of producing, selling, distributing drinks all across Europe, Canada from 3 years ago, as well as the rest of the world in a smaller extent. They're the largest Pepsi distributor in the Nordics, in the Baltics, and growing significantly in Holland, which we'll talk about. And so historically, for a lot of reasons, the company was generating very, very strong returns on capital, very strong cash flow generation, and has grown historically through a lot of acquisitions with a great track record. And so we spent our time looking at every single one of their deals from the year 2000, auditing them, speaking to the company to understand the value creation plan. And as you can see, the returns on capital have come down over the last couple of years. And so for someone who's simply screening for companies, because that's just the easiest way to get around a massive universe of thousands of companies, that company would probably not pass simply because the returns are lower today. But because we had done the early work of studying the history of the company, we went beyond that and trying to understand what actually happened. So obviously 2022, input cost inflation and bad consumer, especially in Europe. But the other aspect is you'll see the invested capital base having a step function increase. So over the last 2 or 3 years, the company has spent about $1 billion in acquisitions. And for context, before that, it took them 30 years to have spent $1 billion. And so as the market was rightfully so questioning the company on perhaps building an empire as opposed to their history of creating value, but maybe in a slower manner, the share price as well as the multiple came down tremendously. And so by doing differentiated work and having differentiated access is how we find a differentiated view on a company. So these pictures were all taken on this phone that you see here, from being on the ground, going to see their plants, and each of these pictures pertain to the value creation story in each of these markets. And for the sake of time, I'm only going to speak about two of them. So in Denmark, at the bottom right, this is a tiny little plant. And I actually learned 2 weeks ago that even the CFO of the company hasn't seen it in person. It's a plant that's located about 20 minutes from central Copenhagen. And even Danish investors didn't bother to see it because they thought it's small and insignificant. But as we were touring the site with the seller of the business, it was very clear how much value the company had added to the asset, whether from adding a lot of distribution, whether from improving their lives from a procurement perspective, walking around the facility, talking about how much less the bottles cost, how much less the caps cost, and also how much less time they're spending looking at procurement, etc. The story is similar across these different markets. And the second example I'm going to give is a screenshot of my gallery in Amsterdam. And so they bought a 300 million euro business called Vrumona from Heineken, and they paid 15 times EBITDA as an entry multiple, which obviously looks terrible when you're just looking without any context. And so we went to the UK 2 years ago, had a group meeting with other investors who were basically questioning the company on the value creation story. And the CFO at the time was really laying it out for them, but people weren't really listening. He was talking about the fact that there was a lot of empty room on the shelves. And so what we did is we flew there. We saw the assets to make sure they weren't underinvested, but we also went to 15 or so stores, including convenience stores, discounters, your regular grocery stores. And one of my colleagues, Alex, is actually going to connect through Amsterdam on his way to Greece for vacation. And he's kindly accepted to go back to the same stores to measure the number of SKUs and take pictures to measure the before and after. So just to give you some insights into the culture at Langdon, which also allows us to take that many meetings, is 2 of our team members during their honeymoons managed to also take company meetings. So it's not a requirement, but we're just wired in a maybe weird and different way. Second company I'm going to talk about is a business called SmartCraft. So SmartCraft is a Norwegian business that offers mission-critical software solutions to SME construction businesses. So think about your electricians, plumbers, carpenters, painters. And so when I first came across this business, it's essentially a rule of 60 company. In the world of software, a rule of X is essentially the sum of the margins and the growth. So think about 40% margins and 20% growth, including acquisitions. And so my background prior to Langdon was in technology M&A. And I thought, well, if a rule of 60 companies trading at mid-teens multiple of EBITDA, it probably means that they're either underinvesting or they're buying companies and just increasing the prices. So it's basically something that's not super sustainable. And so on the slides here, you have 2 examples of companies that they acquired in this first year here. And the company has had a very strong track record of improving both revenues and margins. And in these 2 cases, which are some of the biggest acquisitions they've done, they've ultimately paid less than 3 times cash flow for companies that are still growing double digits very strongly in a very large market. And so by doing differentiated work and getting differentiated access is how we get a differentiated view on a company. Now, unlike with a production and a brewery company, we couldn't actually go and see and touch and feel the assets for a software company, but we were the first investors to actually request a demo of the software. And it's a story that's reoccurring throughout the portfolio, being the first investors to see an asset or to meet some people. And within vertical software, people matter significantly more. And coming back to the slide of the number of meetings, in just a matter of 2 years, these are the number of meetings we've taken with various stakeholders of SmartCraft. And that wouldn't include things like competitors and customers or even ex-customers who've decided to churn, us trying to understand the reason why. The third company I'm going to talk about is hopefully a lot more popular here in Australia, a company called Yeti. In the past, we've compared it to another business called Thule, or if you are Swedish or from Sweden, you would call it Thule. and they've historically traded at very similar multiples. Now, more recently, people have been questioning, and perhaps rightfully so, Yeti's organic growth track record. So in the past, it was more for double-digit grower, and more recently have had some challenges with emerging competition. And so in Australia, I've noticed, and the business is growing very strongly. The story is the same in Europe as well as the UK, a little bit in Japan as well, though it's still very small. And so by building these relationships as we do globally and meeting all these people, we can also leverage these relationships. So the previous CEO of Thule, who had been there for 14 years, in Sweden is nicknamed Mr. Thule. He's one of the most respected executives within consumer, and we hold a very good relationship. So when our lead investor on this case, Isaac, was working on Yeti and the growth story in Europe, we were able to directly send our thesis and have a conversation with Mr. Thule to exactly get feedback on the growth story in Europe. So speaking about the value creation plan, what he thought the company perhaps did wrong, different go-to-market strategies in different countries in Europe, where does it make sense to go direct versus going through distributors, et cetera. And so we were able to get a very detailed amount of data and a great conversation. And the team also, as active and engaged owners of smaller businesses globally, made a recommendation to the Yeti management team for Magnus to join the board. Now, about a week and a half ago, Magnus was actually appointed to the board of Yeti. We'd like to take some credit, although there's nothing in the press release about Langdon. But as investors are today Googling who Magnus is, we actually had that conversation a year and a half ago about what's possible in Europe. And we obviously respect him tremendously and know what his track record is. And so we think by continuously doing culturally differentiated work and getting that differentiated access, that will allow us to continue having a differentiated view on every single one of our holdings and truly stay away from the world of predictions and getting closer to business level observations. And as my peers, I'm also going to show you guys a slide of our performance. We've been very pleased with what it's been so far, especially in the way in which it's been delivered, but we'd like our success to be measured in decades and not in years. Thank you very much.